Hi and welcome to the Fund Manager series. My name is Charles Stewart, the Managing Partner of Market Partners, and today we're lucky enough to have Ying from Coolabah Capital here talking about YLDX and their fixed income portfolio. When I think about the role of the advisor, it's to deeply understand the goals and objectives of the client and to go away and find the best performing fund managers with the longest track record of outperforming their benchmark and try and get the most competitive fee outcome for the client. So today, in the fixed income side, we're always looking for alpha generating fund managers, and we're lucky enough to be able to run through YLDX with Ying. So Ying, maybe you could tell me a little bit about Coolabah and about the fund that you're running.
Thank you for the opportunity to engage on this. So look, Coolabah Capital, we're one of the largest global fixed income fund managers concentrating on investment grade credit, but I should say investment grade fixed income to be precise. The business was set up in 2011, and from there we've grown to running about $17 billion in FUM. We have 53 people in total with one of the largest investment teams. So collectively about 11 portfolio managers and traders and 19 analysts spread across offices in Sydney, Melbourne, London, Miami and Auckland as well, and soon Bahamas as well. But for us, they're very different to your typical traditional fixed income fund manager. So rather than focusing on yield and driving more return by taking on more risk to increase that yield, we're focused on looking for mispriced bonds, and that's our source of excess return or alpha, or the way that we generate our returns.
Yeah, interesting. And so getting to the high yield fund, can you give us a rundown about what's the makeup of it, how much FUM you've got in there, and how you're running the fund at the moment?
So the Coolabah Global Floating Rate High Yield Fund, we actually launched that in February 2025. It's tracking really well. So we currently have circa around 200 million in it. However, we actually launched this fund off the back of a very popular fund that we launched in December 2022, and that has about $2 billion in it. And that fund is called the Coolabah Floating Rate High Yield Fund, and this one is called the Coolabah Global Floating Rate High Yield Fund. Both are very similar in the sense that they are concentrated on the typical sort of bonds that we would normally invest in. So focusing on, government guaranteed entities, implicitly, if not explicitly government guaranteed, oligopolies, monopolies. But that fund has traditionally been more focused on the big banks. So about 85 to 90% of the portfolio is in major bank bonds, and it's quite similar in the Global Floating Rate High Yield Fund. Only invests in senior and tier 2 or subordinated bonds. It does not invest in any hybrids. That has been a very, both funds, but in particular the global, because it has that global focus rather than just focusing on Australia or Australian banks, has been incredibly popular.
Going back to the portfolio, the performance, how has it gone over the past 12 months and performance above benchmarks?
Yeah, so as mentioned, the Global Floating Rate High Yield Fund was launched in February, so we don't have a 12-month track of it. However, it's run very similarly to the Floating Rate High Yield Fund, which is focusing on Aussie bonds. And in the Aussie version, or the Floating Rate High Yield Fund, that has delivered about 7.7% net of fees over the last 12 months. In terms of outperformance versus its benchmark, which is the Ausbond Floating Rate Note Index, it's been 2.5% net of fees as well. Since the actual inception of the Global Floating Rate High Yield Fund, or YLDX, that particular fund has actually slightly outperformed the Floating Rate High Yield Fund. So I think over a longer sort of time period, we would expect some outperformance from the global fund.
Really interesting that you have launched YLDX, the actively traded managed fund, on the ASX. From an advisor's standpoint, a lot of clients are, becoming more fee aware around what the platforms are charging. And so a lot more clients are looking to go off platform and hold investments directly where possible. And so the ability for advisors and clients to be able to access your fund as a actively traded fund on the ASX is a huge boon for investors and for advisors. So first of all, thank you very much. What are you seeing in terms of flows into the fund on a daily and monthly basis?
It's been one of the strongest active ETFs, according to the statistics that we receive from CBOE across like the ASX and CBOE. My understanding is that it's definitely in the top 3 of the most active ETF in terms of inflows. We actually launched this fund off the back of reverse inquiry. So off the back of that very popular floating rate high yield fund, we had very strong demand from the broker community, but also the advisor community for an ETF version of the floating rate high yield fund. And I think a lot of that has been driven, and it's probably a question you're going to ask me later, driven by the foresight that we are going to have a massive wall of maturities in Aussie bank hybrids up until 2032. So off the back of that, as we have hybrids mature, we're seeing, a lot of LICs and LITs come to market. We think this is a superior product to that, in our opinion, given the liquidity and the actual underlying risk profile, but also the return profile as well is very, very comparable to hybrids and some of those potential sort of products that are coming online. So I'd say, inflows continue to be very, very strong off the back of hybrid maturities, but also I think with the RBA cutting rates, and you alluded to this earlier, is that, rates at the bank, on term deposits aren't particularly attractive. So if you are comfortable with bank risk, but you don't want the volatility of bank equities and your bank hybrids may be maturing, or you don't have any bank hybrids, then this is a very attractive opportunity.
Yeah, exactly. And so for clients who are watching this and prospective clients, this YLDX is listed on the ASX. It has a very tight spread that is set by the market maker, who provides almost unlimited amounts of liquidity on either side for both buying and selling. So during times of stress, there's always a buyer and always a seller. It's not like you have to wait for other investors to be there. And it allows investors to be able to access this, with broker liquidity. Settles on T+2, and when you sell it, also, you can use that within your broker to be able to go and buy something straight away as well if you were asset allocating out of one market into another, which is a great advantage as well. So coming back on the macro front, think over the past 6 months, what's been a alpha attribution event that you've been able to take advantage of?
Yeah, I'd say for the most part, for us, it's been a very interesting last 12 months. Obviously, we launched it in February, and shortly after that coincided with April 2025, which caused quite a lot of volatility in terms of markets, very broadly speaking. For us, I think across the way that we manage this portfolio and the way that we manage all other 51 portfolios that we actually run, is we have the same investment philosophy, focusing on the safest issuers in the world, and the ones that have the most liquidity. And so what actually happened across our portfolios more broadly in January is that, and also since last year, we have been generally de-risking. We felt that the market was underpricing the risk of a very ideological Trump. Not an art of the deal Trump. Everyone was focused on Trump making a deal, but we thought, actually, hang on a second, this guy is actually quite serious and he's going to do what he says he's going to do. Obviously, we've seen what's happened after, but essentially we felt that markets were underpricing this. So across our portfolios, and also including the Global Floating Rate High Yield Fund, when we actually launched it, we weren't running as much risk as we normally would have been, say, 12 months ago, had we launched it then. And so we were in a great position to capture any potential sort of blowout in spreads. And so that is actually what manifested. So on April 9, he made his announcement, but we already saw the market weaken in late March and early April. So we saw spreads move wider, which pushes bond prices lower. This is floating rate, so this was only affecting the credit, it was only the credit spreads that were affecting the underlying bond prices as such. But what we saw was that Trump subsequently do a 180. So having de-risked the portfolio, put on hedges up until that announcement. Once he made that announcement, he did a 180, we started buying. So April 2025 actually ended up being one of our biggest buying months. So over the course of April 9 to 30, we actually bought close to about $5 billion of bonds across our entire portfolio. And that, manifested very well, because what we saw is that spreads came tightening in, and that drove, capital gains, which is what we want to see. That's our source of alpha in the fund.
Yeah, nice. That's really interesting. And maybe my last question is, when you're looking forward, what are some of the big events you're keeping an eye on at the moment?
For us, I think, obviously the overall level of interest rates, short-term interest rates and long-term interest rates is very interesting. So right now, short-term rates are still somewhat elevated. We have seen central banks already cut rates. But having said that, we think that the rate cutting cycles are probably going to be more shallow. So we think that the RBA probably has, a couple of rate cuts left. Neutral, they're currently at 3.6%. Neutral, in their opinion, is around 3.1. So that, effectively implies about 2 more sort of rate cuts before they move out of restrictive territory. But the concern really is on long end rates. So on long end rates, they remain quite elevated and quite high. And that's because governments have been, spending money like it's going out of fashion. So we have this interesting situation at the moment where we have, potentially, shallower rate cutting cycles in the very front end in the short term, but elevated, rates in the long end. And what that means is that there's a couple of things. One, it means that long end rates remaining high has implications for obviously all asset classes, but particularly things like equities, which price off the long-term 10-year government bond yield. And so in our opinion, off the back of that, bank equities or equities in general are much less attractive than bank bonds or, bonds in general. We think bank bonds are the most attractive within the fixed income area. But, traditionally the yield that, say, the forward bank earnings yield is typically about 46% over bank bond yields. Right now, that gap or that spread is about 2 to 3%. Which implies that bank equities are around 50% overvalued. Now, I'm not a bank equities expert, but we think that bank bonds are incredibly attractive. So, coming back to this, I think fixed income is a very attractive asset class for that very reason.
Yeah, interesting. And so going back on what I was speaking about at the beginning about the role of the advisors is to find those alpha generating funds. We've been lucky enough to be able to find Coolabah several years ago. We're lucky enough for YLDX to have launched in February. And so, Ying, thank you very much for your hard work, and we look forward to continued alpha on the portfolio.
Thank you.